Okay.
All right. I think we are ready to kick off. It's it's 18:04 on my side, so I think we can go for it. So welcome to the discussion of the IOD, and this pertains to task C, which was covered in the document that we covered last week, and is going to be also dealing with the content in document C. So if we just do a quick recap, the task related to that PBSA, the purpose-built student accommodation. So we are building from there, because when we left it, we understood that we were going to receive a feasibility study report. So now we are intrigued as to what will be provided to us on the day. So if you may go with me in document C, just to then deal with this. And also, if we look at the task really wanted us to respond to this particular email. And when a task requires you to respond to an email, then you need to consider what the email is asking for. And overall, this email had two aspects to it. And as we read through this document, we'll then be able to get a sense of that. But one of the things that I just want you to be able to get right as you go through the IOD is to always keep a critical eye on everything. It doesn't matter whether you've read the task list or not. It doesn't matter whether you have picked up what the task is all about. For me, each and every line has to be read with intention and with that inquisitive mind, where you are asking, why is it there? What is the positive about this? What is the negative about this? So let's jump to it. So Jerry once again emailed us. This time didn't CC Susan. And he said what? Hi then. Following my email to you last week, Varsity Point has provided us with a high-level development feasibility study in respect of the PBSA facility to be constructed in Pretoria. So this is a high level, so there is no detailed feasibility study, but we'll still expect this to be a detailed document. But we are understanding that so far we have been provided with a high level study. As mentioned, the development is set to commence in May 2022. Remembering that at this time, this was somewhere in March 2022 when the candidates were sitting for this paper. So the development was due to begin in 3 months' time. This is critical, as any delays in the conversion of the commercial office building could result in us not being able to open the facility in time for the 2023 intake. And during our pre-information analysis, we got to do what? We got to pick up this as one of the major risks, that there could be delays, and those delays could potentially impact the attractiveness or the uptake of this PBSA by candidates. So we are happy that Jerry is also acknowledging it. And then the question is, if Jerry is telling us about it, and we had planned to tell Jerry about it, should we still tell Jerry about it? Do you think it would be a good idea to say that, Jerry, there is a risk that this will not be finished on time? Do you think that will be appropriate? Because he has just outlined this to us. Is there any insight that we can add Now that Jerry is also aware that there is a risk of this not being completed on time, are there any insights that you could think of? What do you think? Are there any insights that you can add to Jerry's train of thought with regards to what? With regards to what he has just told us. I see a hand. Please go for it. Luto, are you open? Am I not hearing you? Oh, is your hand down now? Anyone who wants to pick it up? Are there insights that could be helpful to Jerry now that he knows what we had planned to tell him?
Hi, Rendani.
Hi.
Don't we have to consider the factors that will have if we delay, like it will affect the reputation of Lampros and all those things?
Okay, so you are saying that you'll still want to just what? Is it a caution?
Yes, something like that, yeah.
All right. Anything else?
Hi, Rendani.
Hi.
We could also, there might be a need for alternative plans in case there are delays.
So you are saying that there might be alternative plans. All right, such as, if I may ask?
Where will students stay? Perhaps look for alternative accommodations for students while this building is being completed.
Okay. Anything else? Anything else? What comes to mind? He knows that this is critical, as any delays could result in us not being able to open. So far you've said that you might need to just caution him that this could be a problem because it could affect our reputation. And then another is saying that maybe, given that there is this kind of risk, we might need to be thinking about our plan B. Anything else? Anything else? Let me see if there's anything coming from the chats. All right, the cost of that alternative plan. So alternative plans such as accommodation and its related cost. Anything else? Think broadly. Show up for Jerry. So Jerry knows that there is a risk, and you are saying this to him. But is there more that you could talk to Jerry about? Just think about the whole structure and the role of Lampros and the role of Varsity Point. Just let's just think that broadly. How do you think we can manage this risk? If we agree that there is a risk of there's a risk of alternative plan that comes with its own costs, and there's a risk that our reputation could be on the line. What will you then want Jerry to be mindful of? Possibly advice on what can cause delays and how we can mitigate that. Okay, but what could cause these delays, Ethel? Let's be specific. Because he is been specific with us. Now we need to be specific with him as well. So talk to me. I like how you have started. Now, you and Jerry might now be aligned, and he might be interested to hear more, but give him more. Give him more. We could lose accommodation revenue stream if we don't comment on the intended deadlines. All right. So he's saying what this, as any delays in the conversion could result in us not being able to open on time. So you are saying that the reason why one would be worried about this is that there could be lost revenue. All right, let me put it, potential loss of revenue. Okay, and then you are saying that delays expected rental to recover that may be due at any point. So sure enough. So I'm glad that you're thinking about it, but help him now, because he has recognized this as a problem, and you have now just solidified the problem to him. Now move from sharing the problem to then being a value adder. So what could then be done about this risk that we are saying that it could cause reputational damage, it could have additional costs to Lampros because of alternative plans that may need to be undertaken, and there could be loss of revenue. What do you think we should do about it? What do you think we should do about it? Ethel, I see your hand is up.
Thanks, Rendani. I think we need to look at it from a technical point of view, from the conversion side, to see what the project plan is looking like from a project management perspective, and if we need to engage more qualified person who can ensure that our project plan stays on course.
Okay, so wait, so now are you suggesting someone other than Varsity Point? Because I'm thinking by the time that Varsity Point present this feasibility study to us, we are already in this partnership. So just to make sure I'm hearing you right, are you saying we should consider as an option dropping Varsity Point? Is that what I'm hearing?
Not dropping Varsity Point, but having a key person whose sole responsibility is ensuring that the project is on course.
You mean like internally in the organization?
Internally in the organization, who is part of the of Varsity Point, who is in the partnership, if I should say, but who is also qualified from I don't know if I should say engineering point of view, but not from, because we are dealing with the business side, but then they looking at the construction side, more or less.
Okay, so let me just make sure I'm with you. So you are saying that, okay, we are bringing context that we will probably not have such a person because we're told that we don't have the expertise, right? So that's one. Then number two, you are saying that maybe from Varsity Point perspective, there should be a dedicated resource that is looking after this project. Is that what you are suggesting?
Yes.
Okay. And then how will you hold that person accountable while you're still here? Or what will be the instructions to that person?
The instructions person would be to always ensuring communication of the set deadlines, and identifying if there's anything that could possibly hinder us from meeting the deadlines, so that we are proactive rather than reactive to missing deadlines.
Okay, so the point is just around effective cost management. Where now you are saying, for example, appointing a dedicated resource looking after the development. So just to add to that, I'll say that they need to be given specific instructions with regards to what? With regards to the expectations, as you said, as well as what? As well as managing the deadlines. Okay, and if they fail, if we do this and this person fails, what do you think we should do in addition? What do you think we should do? What do you think we should do? Because so consider a due diligence, because do you agree that at this point, that's too late? You've already gotten into bed with them. You are now saying that, guys, we're in it together. Yes, the feasibility study. So to say do a due diligence at this point, it might be too late. You have already signed an arrangement with them. So a due diligence would have been ideal if it was before we signed this agreement or before they even presented a feasibility study to us. So what we could do, so I see Lerato is recommending that there could also be penalties, that we say that, all right, Varsity Point, please appoint a dedicated person. Yes, the contract that we need to sign, the deadlines are clear. You need to report to us this interval. This is how far you should be at this particular point. And if you are not there, these are the penalties that we are going to charge, because we are facing this risk. So when I want you to think about it is that if you are to incur a cost, you will want to recover that from somewhere. If you stand for your reputation to be exposed to negative elements, you will want to then recover that from someone. If you stand to recover or to lose revenue, so all these things have got cost implication for you. And for you to then be able to share this with your partner, penalties might encourage them to also be what? To also be mindful of that. So that could be a good way for Jerry to be aware as a mechanism to mitigate these particular risks. So as we are reading, we might need to do what? We might need to be aware of such. We are fortunate that the commercial building that Varsity Point has identified is very suitable for the conversion of this nature. In fact, the existing building's layout requires minimal structural changes. So I'm thinking that what could this building be? So they're saying that it is a commercial building. And I'm thinking that, oh, maybe it had little offices, which could then be quickly turned into what? Quickly turned into rooms. So now they are saying that it is very suitable. I noted the word very suitable. And I further noted the fact that it will require minimal structural changes. So I'm thinking maybe there are already doors, there are already windows and all these things. Then what it will just require maybe is just to close this area and so on, but very minimal. It's not like you are starting this building from scratch, from what I'm reading. But I'm no expert, but let me just go on because I like what they've presented to me. The commercial building which Varsity Point has identified is located just 1 kilometer from our Pretoria campus. So that's interesting. Did you pay any mind to the aspects that have been identified here? So because it is very suitable and requires minimal structural changes, it might mean what? It might mean that the risk of what? The risk of delays is significantly minimized. But by what we've just been told, do you agree? Because it's very suitable and it requires minimal structural changes. The commercial office building has been identified. It's 1 kilometer from our campus. This will enable us to provide accommodation to 280 enrolled candidates. Now, did you pay any mind to what they've just said? What did you think when they were telling you about 1 kilometer? And some of you might have gone to Residence University, and if you have gone to the likes of Tuks, imagine Tuks and Hartfield there, and they are saying that there's the university and this is where you are. If you've gone to the likes of what Auckland Park, Vets, you are now imagining that yes, I'm there just around Bramfontein and so on and so on. I'm just 1 kilometer away from campus. So now, what do you think? What comes to mind? Is this something to note as an advantage or as a limitation to the plans that we've got? So I see a comment to say that what? To say that it could be very accessible to students. So are you saying that, and the benefit of that will be what? So, and the benefit of that, so I see students will prefer it. So since it is close, then what? Then it is convenient and likely to be preferred by candidates. So the uptake is likely to be high. Do you agree? Do you agree? But now let's think about student life. You are a student. Let's just imagine and go through that journey together. So, like, how do you think you'll be engaging with this campus as a student? Someone just walk us through, maybe take us back to that varsity life. So how do you expect candidates to be engaging with this campus? So you wake up, then what happens? Do you walk to campus? Do you use an Uber to campus? An Uber for 1 kilometer? Do you use a taxi? Maybe just walk us through that. Anyone? Because you need to be present. You need to be present. So anyone? So I see some points. Why are you not talking today?
And then
Elisa?
I want to save time.
You want to save time? Okay, you're being efficient. All right. So what is coming to mind? Maybe explore that with me. You're saying that there might be safety concerns. How so?
Rendani, you know what? The truth of the matter is that the crime rate in our country is really rising every single day. And I'm thinking from a woman point of view, it may be 1 kilometer to walk. I might just get mugged, you know. So I don't think just to say that we will be saving transport costs is where it ends. Maybe what I've seen is with off-site campuses, the institution normally provides transport as well. So we may have to consider bringing our own transport to transport the students from campus to this place that we are building for them as well, and which is not maybe considered right now.
100%. And you always need to be this open-minded in terms of the issues being brought forward. It's one thing to think about the positive, but always take a step back and say, what could potentially be the bad around it? So safety concerns, I mean, as you put it, and I would have expected maybe the likes of those that went to Vets. I mean, that place can be a little bit dodgy in the evening and so. And just to say that as a candidate, you will then find yourself maybe starting late. And 1 kilometer is a lot. For walking, say, after hours. And as you said also, even in the afternoon, the risk of getting mugged and so on. So there is quite a lot that could happen from a safety perspective. So one will then be mindful, we need to be mindful that given the high crime levels or crime rates in South Africa, the distance might present safety concerns. And Lampros might need to do what? Might need to hire security to patrol the area, or to do what? Or provide transport, which will come at a cost to the entity. So that's what you will just need to be mindful of. It's good that it's not too far, that candidates, if they want to just walk whenever they want to, they can do so. And however, you want to just bring the other side of things. Then they've brought into just context how big this accommodation will be. It can accommodate about 280 enrolled candidates. The following is a summary of the development for the purpose of our assessment of the investment opportunity prepared by Varsity Point. Now there are numbers. We need to be reading them carefully. So firstly, we're going to buy the building. At what? At 57 million. Construction in respect of the conversion, it's 85 million. Did you stop? Because I was like, hold on. From what you've just painted as the context, did anything look a bit funny here? Did anything look a bit funny?
The fact that there won't be so much work done, the conversion, then now they're spending so much money on the construction cost in respect of the conversion.
Good. So did you then, remembering that when you are here and you are supposed to look at this, you might want to challenge some of the inputs and the assumptions made. So if you tell me that something is very suitable and requires minimal structural changes, I will be very surprised to see that the cost required to convert are this significant. And did it ring reasonability? Reasonability was, then this might not be as suitable, or this cost might not be as what might be overly estimated. Because if you think about it, right, I will have then started being a little bit concerned about this Varsity Point, because from a purchase price perspective, that will be almost black and white, because there will be a contract between Varsity Point, Lampros entity, with the third party selling the building. So maybe that's true. But now I'm thinking that the construction, remember that the one that is going to do the development, and they now tell me that legal work will be required, and they're now charging 85 million. I might be thinking that, no, this is a partner that wants to what? That wants to also take me for a ride. So that for me was a problem, especially for someone who has told me this is the best building we can find. This building will require minimum structural changes. And you tell me that those minimum cost more than the cost of the building. So I'm wondering about Varsity Point and the way they do things, because one of the things that we had discussed during the PRI was just who Varsity Point is and what they're all about. Is it a partner that we can afford to trust? And this for me will have raised some red flags. I will have then considered this to not be as reasonable and looking for a bit more. Agreed? And then borrowing costs to be capitalized in respect of the development, 2.6 million. And in total, it's 145,442 150. So that is the total development cost. Did you have a problem with how this was estimated? So we had problem number one, that the construction costs do not appear to be reasonable. This does not appear to be reasonable, given the what? Given that the building is said to be very suitable and requiring minimal structural changes. Anything else that you had a problem with regards to this development cost? Anything else that you had a problem with regards to this development cost? Were you happy? If you're happy, you can just say we're all good. We looked at it and we're like, all good.
Hi, Rendani.
Hi.
I'm just wondering about the borrowing costs because we don't know what loan they took. It's just a number with which we don't know how they determined the number. Are they just estimating the number, or is it the actual borrowing cost?
Okay, but what does the standard say? Does it have to be actual borrowing costs? And when you say actual, what do you mean? Is actual, are you talking about the ones that were paid or the ones that were accrued? So what do you mean? Maybe clarify that for us.
What I mean is that as far as this detail is, we are not sure whether the loan, was it specifically used for this construction, for the borrowing cost to qualify to be capitalized. And the second point, we don't know the amount of the loan to say, okay, this the borrowing costs are accurate or something like that. Not just actual, as in what I was saying was like, is this figure pertaining to the borrowing costs that were used for the construction, or is it their borrowing costs that are used for other expenses other than the conversion of that building?
So if I'm understanding you correctly, are you talking about, are they really attributable to this particular construction project? Is that what you're asking?
Yes.
All right, sure. I hear you. So let me highlight that in yellow and just note your comment. We'll come back to it. So your comment is, you are questioning what? You are questioning if this is attributable to the project. Excuse me. Okay. Let me see if there's any other comment. They seem too low in relation to what? I wonder. So I'll then just put it, because maybe you're saying initial view, because we don't have quite a lot to judge it now. Initial view, it appears to be too low. Okay, so I'm just noting this. We're going to come back to them because you're still reading and trying to form a view. The cost requires, okay, that's fine, that's fine. For the capital, they took the internal interest, they did consider capitalizing requirements are met, cessation requirements are met. Okay, so someone is talking about the accounting requirements, they applied correctly. Okay, interesting. So we are forming views. Borrowing costs should not be capitalized. So what about the capital repayments? Remember, the capital repayments will then be part of this. Remember, if let's say we are borrowing this entire amount, that's the capital. So if we include the capital, we'll then be double counting the capital because we will borrow this and we'll incur some of the costs. And if someone is saying borrowing costs should not be capitalized, why not? So let's just put this view here. So initial views, we're going to come back to it. Okay. Then they say that the number of student rooms on completion is 280. The development cost per student it's 519,436. And the gross rental it's 90,000. And the total rental is 25.2 million. And the annual operating cost is 5 million. So now let's just analyze this critically. Let's have initial views about this. So now let's consider firstly the development cost of 519. Did we see how they got to it? Did we see how they got to it?
No.
Did you try to calculate it?
Only questioned only what could be involved. They're not really calculated. I can only the one for the gross annual to confirm if it ties up the rental income. But that one I had a question of what does it entail on that development cost per student room.
Okay. Sure. Anyone who calculated it? The development cost per student room.
So they took the total development cost and divided it by the number of student rooms.
So they took this and divided by the number of student rooms, which is 280. Do you see that? Number of student rooms on completion, 145, 442, 150 divided by 280 gives you that. Then they give you gross rental of 90,000 per year. Will you have gone to this accommodation if they're charging 90,000 per year? Will you?
Don't you have to first check what does it include before you can say, would I?
So based on you've
But
gone
I
through
think
this.
7,500 a month is too much for that accommodation. Because if it's 90,000, it's 7,500 per month. That's too high.
Interesting. So now, did you tell Jerry about this? That Jerry, maybe you're a bit ambitious here. You want to charge students 7,500 per month in Pretoria even for a single room.
And there are flats that are going for your 3,000, 3,005. So
there you go, big candidates. You needed to be a student here to challenge this. So here I'll say, hold on, Jerry. 7,500. So the equivalent monthly rental is what? Is 7,500. This appears to be excessive, especially, and I think this will have been probably a bonus for those that have a context or practical context of Pretoria. But if you just had some views about where it is, because we are recognizing that not everyone will have been to Pretoria and understand the surrounding the surrounding rentals. So I could have argued that this appears to be excessive, especially in what? In the Pretoria area, right? And as one was also asking, it might need to be considered what is included in the rental. Is this a fully furnished room? And are the meals provided? Because maybe if we get to a yes on this, maybe the 7,500 makes sense. That I just walk in the morning, I go to the cafeteria, in the evening I get dinner, then maybe 7.5 might make sense. So before I challenge it, or when you are challenging it, you should have considered maybe the other surrounding areas. Because if it's 7.5 and it's just a room, then that must be a very premium room. Even if it's just 1 kilometer from campus, it sounds very expensive. But now with the question that what is included, if then they are like typical rests, then there are laundry, mats, there are also what? There are also dryers, there are also meals provided, then maybe the 7.5 makes sense. Do you agree? So before we challenge it, we need to be mindful of that. Right? Might come with meals, Wi-Fi, gym, and other sports facilities. So we need to be mindful of that. So before we say it is too expensive, I just want you to be this dynamic with the PRI, with the IOD. Don't be one-sided, but always be mindful and be ready to question. And because at the end we saw that there was a requirement or a task to think about other factors, then we will want to just ask and challenge this. But we've put it to what? We've put it out there. Then the total rental, we said that we tested it and it was what? It was 90,000 times 280. So now this is very interesting. So this is very interesting. Were you surprised when you saw this? What is now Jerry assuming with regards to the capacity of this? Or is it Varsity College? Sorry, Varsity Point. Yeah, prepared by Varsity Point. So what do you think?
I think he's assuming that all the rooms are going to be taken by students. It's going to be operating at full capacity.
And what will you have told him? Maybe based on your own experience as a candidate, do you think accommodations like such as these are 100% occupied?
No.
Depends.
Is it,
No.
we have seen, as I was saying, that in the PRI, that we know that in South Africa, student accommodation is really, what do you call this? It's really in demand, and therefore 100% assumption could make sense. But we know that there are also plans for what? For LAMPROS to go hard on online learning. So where do these things all fall together? So someone is saying that at public universities, this might sound practical, but at private colleges, maybe not so much. It might not be realistic to expect 100% occupation. In some instances, there are long waiting lists. So you've got different views, but then what will you then say about it? Let's say you believe this. Do you will just leave it as is, or will you then have something to question?
But isn't it Varsity Point working on experience history, checking all, okay, fine, the previous PPSA that we have done, they had 100% occupancy. So maybe it's working with what has happened before.
But if they are truly working with that, do you just leave it as it is though? Do you just believe and say, these guys know better? That's my question.
I think also on your side as LAMPROS, you know what is it called, the payment history of your student, that they take long to pay. We've got bursary students, we've got this and that. So you must also take that into consideration when you're doing the 100% capacity.
So what are you saying? So we are still talking about capacity. We are not yet at recovery. So we are saying it's 100% occupied. Do you believe? Yes or no?
No.
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 But your point about them having experience with PBSA, is it valid enough to just leave it as is?
For them, it is valid if that's the experience, because you're working with the history, but you must consider also the future, because we're in the COVID times where some people prefer maybe staying at home to avoid, maybe they've got their own disease that they can't be at in with people at that time until the COVID has went down. So it might not be 100% capacity.
Okay. All right, so I'm just putting your points down because we are forming views, right? So some are saying blended learning, no, 100% is not realistic. PBS varsity point has experience, and that's what, and that the accommodation, student accommodation in SA is quite high. With long waiting lists. So this might be practical. So I'm just saying that we are putting it out there. But the question is, how do we bring ourselves to then challenge this? All right. Then the annual costs are sitting at about what? 5 million. Did you check the margins against the revenue? Did you check the margins of this against the revenue? Did you check the margins of this against the revenue? What was the margin of this against the revenue? Anyone?
That's 20%.
20%. How did that make you feel? How did that make you feel? Like, oh, makes sense. Where were you?
With that 90,000, the annual and then the operating cost, you might like, it seems too low. 20%, because we're paying a lot and then they're only spending 20%. You wonder, what are they doing? Are they maintaining their properties? Yeah, what are they doing that annual operating? How are they operating with only 20% and we're paying so much money?
I'm still not convinced enough to give you an indicator. Maybe give me more. So which cost are you seeing that will probably shoot this off outside this 20% range?
The electricity to start off with, Rendani.
So electricity, you are saying, just bearing in mind the electricity costs.
Because they didn't tell us if they're installing solars or anything like that.
Interesting. So this does not, this appears a little bit low, right? Anything else?
I think also operating costs need to include, remember, there will need to be security. There will need to be like admin. So it seems like it's a bit too low.
Security cost and admin. All right. All right. What other cost are you thinking about?
Water,
maintenance,
salaries,
rates and taxes. So this is where we are. So this looked a bit low. This looked a bit low. But we might be saying that we don't have experience here, but it will be good to just take a step back and saying that, let me just consider even the running cost of a car, like even the running cost, maybe you might have a flat and you might say, what are my running costs on a monthly basis? Just taking into account the electricity cost, taking into account the rates, taking into account the security, and so on and so on. So you might then say that this, excuse me, so this might be what? This might sound a bit low. Then they said that it's 25 minus 540, 504, I mean, giving us about 2160. Then they capitalize that at 20%. So they told us what is capitalizing. It is to say B. What is B? Is this rental income divided by C. C, it is this 12% capitalization rate. And what is this technique called? What is this technique called again? The basis of valuation. What do we call this technique? What do we call this technique? What is this basis of valuing?
Not the earnings.
Hmm? What is it called?
Looks like the price earnings valuation. I don't know. The way it's calculated.
Hmm? But what is its official name? So it looks like that, but what is its official name?
Is it not terminal value?
That's not a technique.
The price earnings multiple.
This is not a multiple. It's the earnings yield. Thank you, Ngozi. This is the earnings yield valuation methodology. Right?
Oh,
The
it's
earnings-
dividing, it's not multiplying. Okay, yeah.
Yes. Yes, multiple, multiply. So this is not doing that. So this is the earnings yield. Okay. In addition to the above, Varsity Point has indicated that the maximum bank debt, excluding interest, that Lampros Varsity Point will be able to raise in respect of the purchase of the land and development thereof amounts to 85. And it seems that they are saying that they will only fund this construction, but the purchase price and the capitalized borrowing cost will not be funded. Then shareholders will be required to provide equity contributions for the balance of what? Of the required funding in proportion to their shareholding. Then we're like, oh, wait, let's quickly revise our shareholding from the PRI. It was given as what? Lampros said how much?
40%.
40, and Varsity Point had 60. So just to quickly remind ourselves. So they are saying that this is how then the capital will be raised. I would like you to assist me with the calculations to be performed to assess this opportunity, which will then need to what? Which will then need to outline to the board. I have already prepared an assessment of the transaction by compiling an initial draft of the cash flow forecast and the related calculations. Oh, thank you, Jerry. Please review and provide feedback on my assessment. That is task number 1. Because previously, Jerry was just talking to us. Now, Jerry said something. Please review and provide feedback on my assessment. You will find my calculations in the attachment to this email. So let's note task number 1. Okay. Then I've applied the following assumptions in my assessments. So now, when Jerry has asked us to review, we are saying that what are you expecting us to do, Jerry? So now when you are expected to review something, we are saying, is it worthy of being used to make a decision? Think about it that way. is it worthy to be used for the decision at hand? So for it to be worthy, it has to be reasonable. In other words, based on reasonable forecast or assumptions. Number two, it has to be free from technical errors. Number four, it has to be complete, having considered all the costs that need to be what? That need to be considered, or that are relevant rather. So this is what we are going to keep in mind, that if you ask me and you say, I've prepared an assessment of the transaction by compiling an initial draft of the cash flows, of the cash flow forecast and the related calculation, please review and provide feedback. Then now, if I'm unclear of what I need to do, I need to then make sure that this is decision worthy. And for it to do that, it has to tick 3 boxes. It has to be based on reasonable forecast or assumptions. It has to be free from technical errors, and it has to be complete. So that's what we are going to be looking at. And now Jerry starts sharing his views on the forecast. I know this was written in May, but let's be here today. Here we have had Lisija and team there at the Reserve Bank telling us about inflation and so on and so on. And remember, this is how it works. You cannot assess, when you assess something for reasonability, it has to be compared with something. You cannot tell me something is unreasonable if you don't have anything to compare it to. So you have to have something to compare it to. Does that make sense? So the moment you type or write, this does not look reasonable, you have to tell me in relation to what. If you just leave it there, then I am worried. Does that make sense? I am worried if you just tell me something is reasonable, unreasonable, and you just say, I looked at the cost increase, they appear to be unreasonable, full stop, move to the next line, no indicator, no demonstration of competence there. But now if you then say, I looked at this, it does not appear reasonable in relation to, relative to, considering, and so on, you are now giving me context and you are inviting me to your line of thinking where now I can say, yes, I agree or I disagree. So now this is how I want you to talk to me when we are dealing with what Jerry has put before us. So Jerry then jumps in and say, gross annual rental income is forecast to escalate by 6% per annum. Operating costs are expected to increase by 4% per annum. Do we have a problem there? Do we have a problem? This is what Jerry is just doing. He's telling us his views. Do we have a problem? Do we let Jerry go and we move on? Remember, we test everything for 3 things. Reasonable, free from technical errors, completeness. Yes.
I'm just thinking if we would expect at a minimum the increase in cost to be the inflation, which is at this point in time, I think it's around 7.6. So I think with that being said, it might not be reasonable.
Thank you, Siam. So you have told me that we have inflation at about 7%. And I see you expecting this cost to increase by 4%. I don't think that's reasonable. Because if someone is to give me that, they have to make me understand how did they move from the 7 that is applying generally to get to a 4. So that is one way that we can question what? We can question Jerry. Before we even go to see what he did with it, we are saying, Jerry, the what? The escalation cost, the escalation rate for the costs appears unreasonable given that the inflation rate is what? Is approximately 7% at the moment. So Jerry has got something to consider now. Because if he's to present this to the board and one of the board members is to ask that, Jerry needs to have a reason. So Jerry might as well have a reason. So this 4% could actually be valid. But what we just want to do, we just want it to be prompted to him that this is not believable. And other board members might throw it out because they're saying that you want to get us into trouble. You want us to jump into this project where the costs have been understated. We get in and we have to pay so much and we start making losses. So please go think about this. And if you really believe and you've got some strong basis of why it will be 4%, give it to us for us to believe. Because it's not like we're saying it's wrong, because it's the future and the estimate. So it cannot necessarily be wrong. It just does not appear reasonable. And we want to prompt it for him. Is there another basis where you could have challenged this cost, given everything that we have thought about?
I think also, Rendani, to take into account the national strikes whereby employees were asking for a wage that is higher than inflation. They rejected the increase that is lower than the inflation rate, and also the annual increase of electricity.
Yes.
Because it increases by more than 4% per annum. So, yeah.
Yeah, and you'll say, I'll expect salaries and electricity to be some of the major costs in the PBSA development. These costs have been increasing by more than inflation, and therefore 4% might not be reasonable in this context. But again, you're comparing. Do you understand? So always have a basis. If your basis of questioning does not come out clear, you are not going to demonstrate competence. And remember, because if you're challenging something for reasonability, you have to compare it to something. So you have to be specific on what you're comparing this to. So I see a comment say the question could be, what is the basis of saying this increase what are reasonable? Relative to what? To inflation, that might be too low. So I think it's just a matter of waiting there. But I'll say don't necessarily ask Jerry the question, express your own view. So if he wants to then comment or say something, then he will. But what we are just saying is that we are sharing our view on this. Okay? Good start. The fair value of the property at the end of 5 years has been determined by applying the 12%.
Sorry, Rendani.
Yeah.
Yes, I have a question on the operating cost, ne? So in between this point, like the one for inflation and where one go into sort of like detail to explain the cost that may go up by more than inflation, which one will be, will one get a point? Do they give a point when you have just indicated that the increment of 4% is lower than inflation? Or does one have to sort of like go into detail more of the second point? Thank you.
But remember that this is a matter of demonstrating competence. And here the competence is, are you able to challenge something? Are you able to challenge something for reasonability? So for me, anyone who gives me one or the second point have demonstrated that they can challenge a growth estimate for reasonability, because both of them have got substance. So for me, I'll say that both of them are sufficient. If one goes for number one, that's enough to just have gotten a good basis to challenge the cost. If someone has got number two, that's also a good point of challenging a cost. If now we are then to say, has someone demonstrated, say, some higher level kind of application? I would say the one for number two has gone and even considered the context of what we are dealing with, and have even thought about the typical cost, and have thought about the current economic environment and given us feedback. So the second point has got more elements. And if there was an HLA related to it, maybe that candidate might deserve it. But both of them have demonstrated competence with regards to what? To questioning reasonability of assumptions. Then,
Okay, thank you.
sure. Then the fair value, so then they say also a challenging of the 6% to say that, oh, from a 6%, we see you increasing by this. So related to the earlier point, so someone can relate it to the earlier point to say that considering that the monthly rental appears expensive, the annual increase of 6% in the context of the what? Of the depressed economy, or during COVID-19 recovery, might be ambitious. So that could be another basis of questioning that. Because we have said that this 7.5 was a little bit too much, and also taking into account the depressed economy, that people are still recovering against what COVID-19, but it seems prices across the universe are just also recovering. So it's also a very interesting point, Tinashe, just to say, across almost everything seems to just be getting expensive. So one could then say, maybe it's just to compensate for that, but one could say maybe you might struggle to then achieve those related, what do you call it, capacity. But let's go. The fair value of the property at the end of 5 years has been determined by applying the 12-month forward forecast net income divided by the capitalization rate. The capitalization rate used to determine the fair value will remain unchanged throughout the investment period. What did you guys think? What did you guys think? The capitalization rate will remain unchanged. And it is, the fair value is determined by taking next year's forecast net income and dividing it by the capitalization rate. Did you have any views on that?
For me, I just don't have to consider the current market value, the current market value before we even fix it for throughout the investment period.
What do you mean?
In a way that what is it called? We need to consider the return of the investment for this building. So if it's just capping it to 12%, it seems unreasonable why we're even going through with this. I was trying to just my thought process, but for me, I just feel like it's unreasonable for us to just cap it because the current market value, the current market situation, what we're going through at the moment, and also the return. Now we're gonna get our return if we're keeping it at 12% at the end of the investment period.
Okay.
I just want to ask Rendani, this fair value, does that mean that are we selling this or are we trying to determine the terminal value?
How did you interpret it? Maybe share your views.
I'm a bit confused. That's why I'm asking.
But remember, in the exam, you have to make a call. What did you make a call on? Like, if you had to say, I don't know, but I'm going to make a call, what will be your basis?
I think I'll go with determining the terminal value, and the basis that they're using here is inappropriate, because the terminal value will need to be determined by the cash flows of year 5, and then adding the growth, and then dividing by the work and deducting the growth. Because I don't think that they will want accommodation for 5 years and then sell the property. I think it's something that they want long term.
So wait, so you've got a very interesting point, but I wonder if what you're saying is what I'm hearing. So are you saying that the basis of determining the terminal value is wrong? Or are you saying we should not have a terminal value? Like what are you saying? Just to make sure
I'm
with
saying that we should have a terminal value, because I think the property, the expectation is to use the property for more than 5 years, as well as the determination of that terminal value, if that's what they were calculating, also is incorrect.
And it should be what?
It should be the cash flows for year 5, and then we add the gross percentage, and then we divide it by the work, and the work is from the work we deduct the gross percentage.
Yeah, so that will be 12-month forecast. So it's year 5, and then the 12-month forecast will be what you're saying. We are increasing it to year 6, but the capitalization rate, you are saying that it has to not be this 12, it has to be the work. Is that what you are saying?
That's how I have seen it being done, but I don't know why.
Okay. So did you, as part of your research, consider how property is valued? Because I just want to put it here. And you could then say further research as part of long life learning. But we're gonna wrap that point up before we are done. We're gonna come back to it. The loan repayments in respect of the bank debt will amount to 12,575 per annum, inclusive of interest. The loan will be fully repayable in 10 equal installments of 12,575 annually. The loan will bear interest at an annual interest rate of 766. Did you have any concerns here? Did you have any concern?
If it was a now interest rate, the current increase in interest rate will be different from the 7.66%.
So what are you saying? Maybe be more specific. What are you saying?
In considering the increase in the current year interest rate, this interest is very low.
I'm not sure whether I'll have given you the credit. But because it could have increased and it's now standing at 7. Even if it had increased 10 times, but if it's standing at 7, I will not have a problem with the 766. So it is not the increases
But
that
currently it's standing at is it 9.5 or 10%?
But that's not what you were saying before. That's why I was saying that I will not have given you a credit.
Oh,
Because,
okay. I understand. I need to be specific.
Yes.
Okay.
So because you were talking about the increase, which are a problem on their own, but not enough to challenge the reasonability of this. But now, if we then say that the current prime rate is 10.5%, and the expected borrowing rate of 7.66 might be too low. Because even if we consider gearing, this is actually almost what? Almost a 2% less than prime. That's very generous. Even if we say it's property and property increase of value, is still a bit what? Generous. But maybe if he had gone maybe even a step further and did research and say that on average properties are getting rates at least prime -2, then that could be something else. But for me, I'll have wanted to raise it as this rate appears to be what? To be a little ambitious as well. Then any surplus cash flows generated by the facility will be distributed annually to shareholders in the form of dividends. And Lampros has a WACC of 16.75. We will also need to consider a list of key factors with reasons which the board should what? Should consider in assessing the opportunity. So this one was a bit subtle. It was not as if Jerry was asking us for something. It's like he's putting it out there as a good idea. But we were required to respond to the email. And if he says that we'll need to do something, then it might be appropriate for me in demonstrating my competence to then provide that list. Please note that all tax implication in respect of the transaction can be ignored for the purpose of the assessment. So now let's talk about this. I come before you and I say we are looking at an NPV. And I say, I know the tax implication can be ignored. What will you say to me? Yes, I'm your senior, but what will you say to me?
An NPV should include the cash flows for tax. So it won't be a complete NPV if it doesn't have any tax cash flows.
And there'll be a technical error as well.
So is that what you have said to Jerry? Or is that what you have thought?
Thought.
Hmm?
But not said. Thought.
Why are you not telling that to Jerry? To just say, Jerry, I hear you, but as you put it, it will not be appropriate, or it will not be complete, or it will not be technically accurate to exclude the tax implications in assessing this opportunity. This you will have needed to tell him. You know why this is a good point? This is a good point because it not only demonstrates your technical competence, it also shows courage. Because now I'm coming as your boss and say, no, don't worry about tax. And you then say, oh, no, wait, hold on. But that is not only wrong, but the fact that you are raising it to your senior and saying that it can't be that we're going to get this right, and even go to the board and say, board, don't worry about tax. But tax exists. Tax is important. Tax affects the return profile of a project. So for you to stand up, it is likely going to be what? To be loved so much by the examiners. Did you understand why this point is such a beautiful point? Both technical competence as well as courage. Yes.
Sorry, before we go forward, would it be a valid point to question the WACC? Reason being, Lampros has never been in a project where they were involved in PPSA. So the WACC or the risk that they are facing at the moment, like their current WACC, they don't have projects that are similar to the one that we are looking at. So would it be correct to use the WACC of the company?
But this work is not the one assessing the opportunity. Remember that there's an entity that will then be holding the cash flows related to the opportunity.
Mm-hmm.
So that will have its own work. Now, when we receive this cash, then now we are then assessing these cash flows using the work. So are you saying that assessing these cash flows using the work is inappropriate? Is that what you're saying?
Yes.
Are you sure?
No.
But sorry, not to get to focus. But yes, so essentially, yeah, that would be an interesting point. Because I think even here there's a bit more in terms of the technical knowledge, because there are views. So maybe we'll touch on it. There are views that says that because you've already removed the finance cash flows, to come down here and then discount this by the work, it's also questionable, because these cash flows are specifically those that belong to you in your capacity as an equity shareholder. So one will then say, maybe should we then use the cost of equity, or should we just use the work as is? So that is something that one could also ask. But with regards to the risk, that will be a valid consideration in terms of assessing your own cash flows. Really, does the risk aligned to these cash flows still represent the risk related to your existing operations? Right?
Thank you.
Sure. But yeah, interesting point. Maybe let's note it. So the cash flows arising from the PBSA development, they might have a different risk profile, and it becomes questionable whether the existing work is appropriate. Yeah, so I will have put it in as well. I think it's a fair point. I think it's a fair point.
So
Okay.
sorry, Rinjani.
Yes.
May I ask on the loan repayments? I was of a different opinion to say the loan repayments which Jerry has given us. I felt that they were a little bit specific, as if it's not more about Jerry's assumptions, but could it be maybe there is a kind of a loan agreement or something which we've already agreed with the bank? Can we question in terms of that? Because when I looked on the specific, I looked at it rather on a different perspective, not considering that these are assumptions. I don't know if I'm correct from the way I looked at it. Because it's not always that, like, when we get a loan, it's always prime plus. At times it might not be prime plus, but that's how I looked at it, to say this looks rather more specific. Because even if you take your PMTs and then after that you do your PV, you tie back to that 85 million. So it was one of the things which looked outstanding on a different perspective, to say this looked like we have kind of a, could it be a draft loan agreement which is already in place? I don't know if I was correct in that perspective.
All right, but yes, I think I'm with you. So you're saying that we'll probably have an indicative term sheet, but where are you taking it? Yes, I just want to see where you are taking it.
Yeah, like I was looking from the fact that we were questioning to say the 7.66.
Okay, yes. Oh, you mean this?
Yes.
Oh, okay. I'm with you. So here it depends, and I think because we don't have a view or we don't have details, it could be that he's basing it on what he has seen. He's basing it on the current borrowing rate. It could be that he's basing it on the current term sheet. So if it's the current term sheet, then that could be also a situation where it's something that has been confirmed as you're putting it, and therefore it is not subject for questionnaire reasonability. But if it is just his view, maybe based on what he's thinking, then it might be worth questioning. But at this point, because we don't have this, we might want to then just challenge him. And he can then respond that, no, I've got a term sheet from Bank A. Do you understand?
Okay.
Yes.
Okay.
Yeah.
And also, Rendani, at the
Yes.
top, he said, I have applied the following assumptions.
Mm,
So we'll take it as an assumption.
good point.
Okay. Oh, thanks very
Good
much.
point. Yeah, good point. Thank you for that. Yes.
Irene,
Hey. Hi.
I have a question on the tax issue, ne? Like,
Mm.
when do you know that now it's time to have the courage, or I should completely ignore? Because sometimes when they say something, you should ignore something, then you ignore it. But now here, when do you exactly know? Do you have to assess the nature of what you are doing, or I don't know? I'm a bit confused there.
But context is important because sometimes they might say, like, this might have what? This might have accounting implications. Like this borrowing cost, yeah, you are buying a new property, you are entering into this. And remember that I had that trigger about that you could be questioned on what is the nature of this thing. So they could have said, ignore the accounting implications of accounting for this. But ignoring that has no impact on the exercise being undertaken here. So that could then be a situation where the other is just a separate work stream. Whereas here, this is an important part of this work stream. So that's
Okay.
where there is a difference here. Because in the other instance, you'll see that it's a separate work stream that they're saying, don't worry about it, because if they don't say that, considering that work stream might just be you demonstrating competence.
So that means that because you cannot have an NPV without tax. So
Yes.
if you remove tax, it means that the NPV that I have is incorrect. That's why we need to take it into account. But
Yeah.
if we say ignore and it doesn't have an impact on the current thing that I'm evaluating, then I can ignore.
I will say that might just be one way to think about it. Yes. Yes.
So it's just a matter of indicating that we should consider the tax implications, but not really going into details. I don't know, like now start talking about if there are any allowances and all of that.
Yeah, no, here there's going to be tax. There's just no way. So here there's going to be tax, and it's important because you are talking about sharing dividends. But if you have to get dividends, dividends will be reduced by the tax that has to be paid. And if you're assessing whether the return is appropriate based on dividends received, that's an issue if you have not taken tax into account. So here tax is fundamental. And that's why we have to tell Jerry about it. The board will throw this away if it takes it to them without tax.
Okay.
Yes. All
Sorry,
right.
Rendani. So just on that point, because I think there was a similar sort of a task on the same case study, just to move away from the cash flow, to say that, you know, you had two funding options on the investment, but you know you should ignore the tax implication. But when I looked at the reflection of that video on that task, one of the candidates did consider that the interest is deductible from a tax perspective, and that credit was given. But in my sort of thinking in the response, I thought of it, but it came back to say, remember, you should ignore the tax part of it. So but me ignoring it seems like I did not end that credit. But when I looked at the reflection video, it was sort of some of the things that you could have pointed it out to the board, that yeah, if a loan has a tax deduction as opposed to equity. So I think, yeah, there could be some gray areas in terms of how you respond around it. But I sort of get the sort of the point of how do you get that courage, you know, in terms of like the NPV, because the NPV might be a bigger part of the tax implication.
Now, it's an interesting point. I hear where you're coming from. Because it's like now the trust relationship between you and Jerry keeps on growing. And maybe that's the kind of relationship you need to have, just to say, I hear you, but yes, you've told me this, but kind of. And that's why I was saying that for me, if they're saying don't do this and it represents a separate work stream, that makes sense. But if it is so important to the current work stream, it's so difficult to ignore. Does that make sense?
Yeah, I know, especially from like a strategic point of view. Yes.
Yeah, because we can't ignore it. We can't. Okay. So now let's jump into this. Alten will be coming in soon. So now they have been given, let's just first see what we've been given. Because, yeah. Okay.
Just a question on the borrowing cost. When I first saw this, I said that the borrowing costs shouldn't, because this is an investment decision. I didn't want to, and the borrowing cost related to financing the project. So I always thought I need to keep the financing decision and the investment decisions separate. Are we keeping the interest in the workings because the loan is specific to the project, or where did I go wrong?
All right, let me hold that question. We're going to come back to it. We're going to come back to it. So I think firstly, one needed to be very careful of what they've been given here. So one, they've been given a cash flow summary, and two, there is the fair value of the property, and three, there is then the NPV as well as the IRR of the investment. So those are the three things that we've been given. And let's also think about the structure. Firstly, there is entity number one, which is Lampros, entity number two, which is VP, entity number three, which is Lampros VP. The entity that is going to undertake the investment, it's Lampros VP. And we, as Lampros, we are not going to be developing, we are not going to be managing. We are just going to get cash flow from that. And the cash flows that we're going to get are dividend cash flows, right? And in exchange, we need to then be buying the investment that will give us access to that dividend cash flow. So now we are analyzing what will be the cash flow coming from that investment. So here, do you see the context is different? The context will be that Lampros VP, the entity, will be the one that undertakes whether this investment makes sense or not. But now Lampros is a shareholder in that company, and it's not even a majority shareholder, meaning that what it is entitled to are just the dividend cash flows. So that means Lampros will need to run an analysis to determine the dividend cash flows. And this is on the back of Lampros VP will be investing in this particular project. So Lampros VP, once it has invested, Lampros, the entity, will not need to run another NPV for it. It is saying that if you are investing, then this thing makes sense. Now the question is, you want me to put equity and get dividends. So I'm just an equity investor. And you will remember that if you're an equity investor, you've got your return in the form of dividends and the capital appreciation. And that sounds like the dividends growth model, because the dividends growth model is what is the dividend yield plus the capital appreciation. So you are an equity investor and those are your cash flows. The entity Lampros VP is the one that will undertake the NPV for the investment decision. You will take an NPV for the financing decision because you want to finance and buy an equity that will give you right to the cash flows. That is the structure here. Lampros is not the one evaluating this. It is Lampros VP. Are we together? And the assumption is that that has been done and they just want our cash to come in. So that's why this calculation looks like this. It has our investment, it has our dividend yield, it has our capital appreciation, and we are now saying this gives us the cost of or the return on our investment. So the analysis here of saying how much cash do we have out, it's appropriate because we are not undertaking an investment decision. It is Lampros VP that will take that, and we are assuming that the reason why they will ask us for money, they are going to make money. Are we all clear in terms of that? All good. So now, let us quickly wrap it up. So gross rental, let's look at this. I love SAICA. SAICA, I feel they are very generous. So remember, this is Jerry now. So Jerry says gross rental 25, 25, 25, 25, 25. So when you look at this, did you have a problem that you wanted to raise to Jerry? Oh, this looks good. Gross rental.
There's no annual escalation rate that he said he's using.
And we are saying that is against number 2, right? So that is problem against number 2 because we say it has to be free from material error. So there is an error in that the escalation has been excluded. I mean, like psych. Then operating cost. Do you have a problem with that?
No escalation.
So still the escalation one. And another problem that you had?
I think, Randani, on gross rental, I also took from the perspective that we can't expect from year one, we are already operating at full capacity.
Yeah, and I think that's, and I don't know whether you had a problem with that, but I'm going to come that as a problem. So that's a very interesting point. So problem 2, so on operating cost, we said that also it has not been grown by that. Any other problem you had?
I think also as property ages, the maintenance costs increase.
Yeah, so that will be
also on that
part of
escalation as well.
Yeah.
To say that the property, as the property ages, more maintenance is required, and therefore we're expecting an increase.
Okay, I will have given you as just the escalation has been excluded because I think that one is just going to be probably a bit more insightful to say that you probably want not a consistent rate, but you want maybe a rate that increases over time. That would have been very insightful. Yeah, I will have put it as an HLA. I love it. But anyways, where are we? Yes, so problem 2, you are saying that the operating cost omitted, the escalation, and even more, we will expect the escalation to be higher over time as the property ages. Lovely. Anything else? So did we have any other problem number 2? Signage?
Added,
Yes.
yeah,
And I mean,
operating costs.
guys, talk to me. Are you not happy to see this? This is official cycle. Operating costs have been added instead of what? Of being deducted. And a quick review will have then said, you are now telling me net operating rental is 30, whereas earlier you told me it's what? It is 20. So how did it now just jump? Then you'll have said, oh, yes. There, now you seem to have been adding the two numbers up. Then repayment of loan, do you have a problem with that? Do you have a problem with that?
Yes, because they said, Jerry said it's going to be 12 million.
So you could
every
have
year.
raised it as a problem 2 or 3 to say that the cost appears to exclude the interest, or rather what? Or rather that is 10 million versus 12 million. Is it 12 points?
12.5, 12.6.
12.6. Because that was quite surprising to see what is happening, Jerry, because you told me this and now you're using this. Then Jerry has got net cash flows, and then
Sorry, Danny, I have
yes.
a question to ask. So the repayment term is actually 10 years, right? Because they said you're gonna pay 12 million per year. It's in 10 equal repayments. So I wanted to check with you, this term that we have of 5 years, now it's not, what must we do? Must we rather say that the project must run for 10 years, or must we then convert or increase the payment so that they fit the 5 years? What must happen?
Oh, so what will happen is that you will then say what is the original loan, right? What is the original loan, by the way? How much is going to be borrowed? So the original
85.
loan is going to be 57, right? Or is it? Yeah, because they're going to sorry, it's going to be 85.
85.
Yes. So the original loan is going to be 85, and it's going to be paid over by this 12 million, right? So now you are saying that if it's 85 and we're going to pay 12 and we have now paid for 5 years, you will need to say what is the balance of the loan? What is the balance after 5 years?
Okay.
What? So now let's calculate it together, right? So then we are saying that after 5 years, because our evaluation is after 5 years, we'll then say N is the remaining 5 years, right? Because 5 years has gone down. And PMT is 12,575,087, and future value it's 0, and I it's 7.66. And what is now the present value after 5 years? What is the present? Because that should then be the balance of the loan. How much do we have? It is 0. What is the balance of the loan?
$2 million.
How much?
I got 5661.
50.6 million, right? So this is then the balance of the loan. So to your question, right, it is that what will happen in 5 years? Because in 5 years, we assume that the property will be sold. We then have to say we're going to sell the property. But before we get any cash from the property, we need to pay back that 50 million. Does that answer your question?
Oh, okay. No, it does.
So now let's look at this. So they are now saying that the fair value after that period is going to be what? Is going to be 13 240 divide by 12%, and that gives them 168. And they say the outstanding bank debt, it is 38 million. Hold on. What did we calculate the loan balance to be?
About 50 million.
So this is wrong. So this is a lie, actually. So this is incorrect because based on our calculation, the bank balance should be 50.6 million. Do you see that? All good. And now the dividends. Did you have any problem with the dividends calculation? So the net cash flows are calculated to be 20. And then we've got the split of the surplus cash. Did you have a problem with that?
Yeah, the split was incorrect as well. Supposed to be the other way around. They gave Lampro 60 and gave us 40%.
So the split of the surplus cash is incorrect. Lampros has 40% shareholding instead of 60%. All right, then the fair value of the property after 5 years is 168. What do we know about properties? So what is the general assumption around property?
The fair value is determined by the market because it's widely traded. So we need to look at the market to determine the cost rather than using the cash flow method.
Is it? When you say properties generally traded, what do you mean?
The prices of properties, they can be found in the market. So it's not like you're gonna struggle because there's no market for properties.
But it does not make that how people determine the price could be just based on the discounted free cash flows or the earnings method, just like we've done here.
The value is normally higher than what you usually buy it, like what you bought it for will be higher most of the times when you're selling it. So it appreciates rather than depreciates. So you would expect to sell your property at a higher price. I don't know.
Okay, so we generally believe that property appreciates over time. And when you look at this, what was the fair value of this property when we started?
168.
168. And now the property is estimated at what?
168.
Did that not bother you? That property generally appreciates over time. However, in this case, the increase over a 5-year period is less than R1 million. This sounds what? Like an understatement, given what we understand. I mean, over a 5-year period, this property only increased by 600,000. That sounds very low. It might not be reasonable. Please, Jerry, look into it. All right, then they say NAV, which is the net, then Lampros share, which is what? Now it sounds like this is now better, right? Because 130 times 30%, what is it? Times 40%? What is it? Oh, 12. Yes, 52, right? So this looks much better. Do you see that? And then that's our share. We put it here. We put the dividends here. We then include the share of our investment, and we then include, we then determine the NPV and the IRR to be 6160. So these were some of the factors or issues we'll have raised in responding to this task. In terms of the key factors, we have already identified a couple here with regards to the delays in the delays in the construction, security concern, and we've also spoken about that it might be unrealistic achieving 100% initially. But I think someone was then talking about the point about that 100% capacity in year one. And when we were talking about it earlier, it came through as a consideration. And now it seems that it could be a problem number one issue where you are questioning reasonability. What do you think is the appropriate way to handle this? Do you raise it as a consideration, or do you raise it as part of evaluating the forecast? What do you think? What do you think?
My son Rendani, in most instances, the lines get blurred. So sometimes I struggle to differentiate the review and other consideration. I find myself mixing everything up. So maybe further guidance from here will help us going forward, because in most instances, I find myself having taken key considerations and put them in the review and stuff like that. And then sometimes it doesn't end well.
Doesn't end well. So this is, it's a challenging issue, because sometimes, as you said, the lines get blurred. So I will then said, as a basis, you should not worry too much about it, because this is an assessment of professional competence. If you raise an issue and you adequately raise it, whether you are raising it as part of challenging the forecast or raising it as an additional matter to consider, then you will likely score the credit. And I think that for some point, there is that just kind of gray area. But for some, it might be clear that this is more of challenging what you've done. But in other, it could actually be considered to be either or. And in such an instance, you will not be penalized. So I will not want you to be overly concerned. Just be specific and clear about an issue. Are we clear?
Yes.
Great. And I think I need to jump here, where we're required to do any calculations, like for you to determine whether that loan of 50 million balance, you needed to do calculation. And the question is, as a general guidance, what are we supposed to do? As a general guidance, I think you will remember that there's always that line that trust my calculation. I do what is it? Assume the mathematical, the arithmetic is correct. But here we didn't see that line. Did you see?
No.
And because we didn't see that line, one could say it's a fair game to then expect you to recalculate a number. And the question is, which one? Then up to so far, there was no number that we needed to recalculate. This was the one that we'll have needed to check And here I did recalculate myself, but I found that they were right. I also recalculated this and I found that they were right. So you will be expected to do what? To do some of this sense checking. This, I will have said that it went over the board, and it's more likely that they might have considered it to be higher level application, where someone says, I've got a number, I don't know how it was calculated, let me check it. But if they had said that the arithmetics were accurate, I would have assumed that then they've used the right impulse to get to the correct output. And the same I would have believed about here. So that is probably a general guidance that I'll leave you with.
And Danny, I just had a quick question, please, before you jump off. You know that part that talks about other consideration, I'm sitting here thinking, to what extent does one go? And why I'm saying this, because as part of the research, I went as far as getting into the space of REITs, you know, that real estate investment trust, because when you're looking at this scenario that we're sitting with here, Lampros does not necessarily have an interest in owning these purpose-built establishments by virtue of them only holding 40%. So, and even if you look at it, they are only building, how many rooms is it? 230, 280.
Great, yeah.
Look at the number of their students. They are in about 12,000, I don't remember. And that's when I was thinking, would it not even make sense then that they should just invest in a REIT in that vehicle instead of going through this whole trouble that they're going through now?
Yeah, and I think maybe here, what could also be aligned to that is that why are you entering into this? Do you want to just accommodate only your student, or do you actually want to make a return in property? Because now that will also help in terms of mitigating that risk of saying that what? Of saying, what if we don't get full capacity, for instance? So it's those kind of things that one will have then gone an extra step to think about. Why are we doing this? Do we want a return, or do we want to build our competitive advantage with regards to our campuses and our enrollments? So that might be the consideration there. But let me run. Elton, sorry
Hi,
to steal
Vindani.
so much of your time.
Vindani, can I ask one question?
Sure,
All
last
good,
one.
all good.
I wanted clarity. I think I missed the point you mentioned regarding the inclusion. Isn't we have a repayment of the loan? So that's like fine. Like, at what point do we consider the financing in an investment decision? So now I'm confused because I'm seeing that when we're coming up with the work, our debt is included, like the share between equity and debt, and then we have a repayment of loan that we've included in our cash flows. So on that part, I still have a gray area on why are we considering the repayment of the loan in our cash flows.
I think you're on mute, Rendani.
You are muted.
Then you're on mute.
Sorry. So I'm saying these are not our cash flows. These are Lampros VP's cash flows. These are not ours. These are Lampros VP's.
Oh, okay.
So that's a different aspect. Our cash flows are this, and we are assessing the attractiveness of our equity injection.
Oh, all right. Okay, that makes sense. Okay, thank you.
All right. So thank you so much. We'll leave it here. So any chats, I'll just respond to them via break rather. And then maybe you can take a short break. Elton, how much time do you want to give them?
So I'm in load shedding at the moment, but it should go on like soon. So maybe can we start at 8:15? So it's almost 8:05 now, so 8:15.
All right. 8:15, we are back, right? Thank you, everyone. I'll respond to the queries during break. So 8:15, we are back.
Thank you.
Thank you so much.